Ladies and gentlemen, Tesla stock went from bad today, down about 1% for a majority of the day, to way bad by the end of the day, actually closing down almost 4%. Now, there is news to share with you, and I will do that here in this video. Honestly, I don't think it matters at all. I think, as I said in the last video, Tesla stock should have been green today, given the broader rotation that we've seen, the areas of the markets that participated. Tesla being left out of the market rally today will catch up to Tesla stock, meaning that I think this was the wrong move today. And I'll explain a little bit more why I think that and what is coming next for Tesla and the broader markets. But first, obviously, we have to get into this news that tanked Tesla stock into the end of the day today. And you might be surprised by this. Well, it actually appears as if the news that caused Tesla to fall was actually news we talked about in the video earlier today at 4 p.m. Like, well before the markets reacted to it, we talked about it. It is Tesla potentially being excluded from EV buyer credits in the California proposal. It says here, according to Bloomberg, Tesla's electric vehicles would be shut out from consumer rebates under a proposal by California Governor Gavin Newsom, pitting the prospective Democratic presidential hopeful against Republican power player Elon Musk. Newsom on Monday unveiled plans to offer rebates to EV buyers if U.S. President-elect Donald Trump repeals a federal subsidy. A program California phased out in 2023 could be rebooted in lieu of the $7,500 tax credit, the governor said. Gavin Newsom's office told Bloomberg News that the current proposal includes market share limitations that would exclude Tesla's popular EV models. The details, including Tesla's possible omission from the credits, will be negotiated with the state legislature and could change, Newsom's office said. They said, quote, "It's about creating the market conditions for more of these car makers to take root," according to the governor's office. It wasn't immediately clear if other automakers would be excluded. So let's get this straight. I mean, I don't live in California, but if I did, I would be pissed off by this one. Because why punish the American car company that's like pretty well a staple in your state, which is Tesla, to benefit perhaps Toyota or Kia or even Ford and GM for that matter that are based out of Detroit, which I live in Michigan. Like, I don't really see the point of stiffing Tesla. I guess that's just what the last government official agencies did, I guess. Doesn't make a whole lot of sense to me. Now, regardless of opinion, I don't think this matters for Tesla's business. I don't think a 4% fall on this news makes a whole lot of sense. I think we can all agree with that. So, this is a nothing burger, okay? This caused a lot of selling for no reason. And it won't surprise me if Tesla bounces back from this pretty sharply. If Tesla does not immediately bounce back from this, I think it's a massive buying opportunity. I mean, the stock's now $338 per share, especially if it falls further from here. That would be a blessing to be able to buy Tesla at the cheapest price possible, because a lot of people are starting to suspect that we will actually get a Santa Claus rally after all. And I mean, we're seeing the analyst price targets coming out for 2025, and they're crazy high. I mean, maybe all Wall Street analysts are going to be wrong. Maybe next year is a terrible year. I guess with everyone being so bullish, it's not a great sign for sentiment heading into next year. But, I mean, come on now. Like, we're probably going to have an end of the year rally. And Tesla's going to participate. Rightfully so, Tesla should participate. And I think it does, again, nothing to Tesla's business being excluded from a California tax credit. If that does indeed happen, who's to say that Tesla wouldn't be the only company from the government's perspective that would still get the subsidy? I mean, I don't see Tesla getting stuffed or snuffed on this. But that's the news that is affecting Tesla stock, or did affect Tesla, into the end of the trading day today. And again, back to the earlier commentary, I was surprised to see Tesla actually not green today, despite 10-year Treasury yields falling 13.5 basis points. 10-year Treasury yields falling like just on a 1-for-1 ratio makes it cheaper for Tesla to offer 0% or 2% loans, because what Tesla is doing is they're buying down the interest rate, which is really derived from the 10-year Treasury. So as the 10-year Treasury yield goes down, Tesla has to spend less money per vehicle to buy down that interest rate. Kind of like when you buy down an interest rate for a home, right? The lower the rate is, you know, the cheaper it's going to be, you know, to get a lower rate, right, when you buy it down. So this is a positive for Tesla as far as a profitability basis. And as I explained in the last video, just that in and of itself, if we do start a new trend of 10-year Treasury yields starting to fall, because, you know, yields tend to trend. We've trended up for a while ever since September 13th, right before the Fed's 50 basis point rate cut. And this is a sharp drop. If you trend lower, that's going to be very supportive to Tesla and very supportive to the rest of the markets. And again, as I explained already, that's why the Russell massively outperformed the NASDAQ and the S&P today. The Dow outperformed as well, 3 times that of the S&P 500. The Dow was up almost 1% today, 0.99% to be more specific. But the Russell outperformed even the Dow, going up 1.5% today, which is very impressive. And a lot of Wall Street's starting to say that this market rotation is just getting started. And I think that's really going to be the topic of conversation in 2025 as well. You've seen stocks today like Nvidia and like Netflix and even Meta and Microsoft that were in the red today because of the Treasury Secretary that was appointed or chosen by Trump to lead that department. It's the three threes, okay? It is 3% GDP, 3% deficit by 2028, and 3 million barrels of additional oil to be pumped out of the ground. This caused oil prices to fall 3%, which positively impacts inflation expectations and prices for gas, in which you'll see at the pumps over the next couple of weeks, right? That pushed down bond yields because for the first time in a very long time, someone's actually sounding like they want to be fiscally responsible with higher GDP growth, like not sacrificing the economy to get the deficit lower, but to get the deficit lower and have a very strong economy, to boost real growth in other terms and stop spending as much money. That's something we have not heard ever, maybe before. It's been decades since we've heard any kind of fiscal responsibility be proposed, let alone, actually happen, but propose. I think you got to go back to like the Clinton administration to hear any, fiscal responsibility, even being proposed, let alone actually worked on. So that was huge for markets today. It didn't benefit Tesla. I think if this is a trend that is going to start, it will benefit Tesla. Take a listen to this clip on CNBC that says this rotation trade is just getting started, according to KKM's Jeff Kilberg. And if this is true, that means Tesla stock is going a lot higher. I still think Tesla can reach all-time highs by the end of this year. And part of that is clearly you need to see a broader rotation in markets. You need to see that continue. It's not likely that Tesla is the only stock that's going to do well. I think it's actually big tech that's going to lag the markets, and the rest of the markets that actually starts to outpace, something that probably should have happened a while ago, in my opinion.
How should investors position ahead of the short trading week? Well, we're already kind of in it as the markets touch new record highs. Jeff Kilberg has some thoughts. He's KKM Financial's founder and CEO and a CNBC contributor. Jeff, come at us. Where are you most in line with the market, and where are you most out of consensus?
Well, first, I got to give a little hat tip to producers. It's no mystery, Kelly, that I am the first guest on after the mullet rally because I had an unbelievable mullet back in the day, but my dad made me cut it before I played football for Coach Holtz in Notre Dame. But when you talk about what Santoli as well as Ken were talking about, this constant debate between growth and value in timelines, I think it's really been interesting. We've seen fits and starts, and here we are today with a new record high in the S&P 500, above 600 in the SPY, above 6,000. We talked about this a week or two ago. The air is very thin above 6,000, so I think this is actually going to be healthy. I know we're in a Thanksgiving week where volumes will be a little bit lighter, but I think this rotation trade, I think it's just getting going. I think it makes a ton of sense as you see profit taking. This isn't catastrophic, but when you look at the top 10 holdings still at 35%. Those top 10 holdings, the S&P 500, have to be reset, not back to its 50-year average down at 21%, but I think it makes a ton of sense from the profit taking, and that's why you're seeing NVIDIA. Even Meta is down today, and that's interesting to me because you're seeing some of the blue chip name get bought off of that profit taking. The money's not going out of the market, Kelly. We've had 3 consecutive record weeks of inflows, of equity inflows in the U.S. equities. I just think it's going to continue to rotate.
What do you think about this rotation? Are you heartened by that?
I am. I mean, as the manager of the Essential 40 ETF, you know that some of these names that we love and own, we actually own them, Ty, in an equal weighted manner. So if you look at some of the unloved names, look at the CME group, which should do well if we continue to see Treasury yields oscillate. But there's also an IBM. There's a Waste Management. The only time you hear Waste Management, Ty, is when you talk about the Phoenix Open and how many cocktails they're selling at the Phoenix Open for Waste Management. But I think if you also look at energy, which has kind of been perplexing all year, I think if you look at a leader like Exxon, I think I want to own these blue chip tangible names. So we're adding to these positions. We own all 4 in the Essential 40 ETF, ticker ESN. But I think you're going to continue to see this rotation amplified as we go into Q4 because people are getting a little bit concerned about how NVIDIA has had back-to-back 200-plus years, so that's where you're going to see profit taking. Don't exit the position, but bring it back down to an equal weight. You still want to own these names, but it has to rebalance at some point.
Maybe we can show a 5-day chart or so of NVIDIA, which was initially pretty much positive after earnings, but then Ken has hit something of a soft patch. But I wanted to go back to something you said a moment ago. We were kind of talking about tariffs and tax cuts and how these things all take time, but I'm seeing a little bit of this kind of thought going out there now that what if next year is a worse year than people anticipate? Because look, at the end of the day, cutting money from the government is austerity that in the short term is a problem for growth. Tariffs, the uncertainty around that. The Fed may not be able to cut rates that much more. So because inflation is still sticky. I mean, you could all of a sudden paint a picture in 3 or 6 months' time where things don't look all that great.
When you say a worse way, you mean the stock market?
Both. Maybe the market now is kind of pricing in all this euphoria, but what if the reality when we turn the corner into 2025 is much different?
Well, if we remember back to 2016 to 2020, Donald Trump did whatever he could to keep the market up. He judged himself more than I think any other president on how the market was doing. But there were a lot of times he would send a tweet out about tariffs and we'd be down several handles, like without hesitation. And he wouldn't come out and correct that immediately. I'm hoping, despite his partnership with Elon Musk, his tweeting is a little less frequent this term than maybe he learned something from last term.
Jeff, what do you think about that? I mean, again, just to go back to, and by the way, everyone here knows when a new CEO takes over a company, what do they want to do? They want to crash the stock price. So by the end of the term, they look like they're doing really well. You don't want to come in with the stocks at all. You want to come in, crash the thing, and then maybe by the end of it, you go, all right, now we've righted the ship.
Well, and I think that optimism since the election certainly is represented in the market. But I think the one catalyst which could reset and revalue the marketplace specific to equities is interest rates. The Fed's lost control of the long end of the curve. And I think when you continue to see them reissue, we were excited to see Scott Bessent come in because that's where yields are dropping today. A big drop, by the way. But I think at the end of the day, the bond holders and the bond buyers, they're going to dictate and determine where those yields go on the long end of the curve. And I do see with all this issuance, I think you're going to see yields move higher. And that's going to keep a lid, in my opinion, short term for the next month, 2 or 3, because these policies that you talked about, the new Trump trade, these policies, there's a lag effect. Nothing's going to be implemented on January 21st. So that's where I think the market has to digest what's real, what's not. What was marketing during the campaign and what's going to be tangible and actually be implemented in the next year or two.
Capital Markets Chief Investment Strategist Brian Belsky is with us today, has an S&P target of 6,700 for next year. Brian, good to see you. Welcome.
Thank you so much for having us. Good morning, Squawking on the Street.
You do write a time for some common sense and prudence and even some humility. What is that about?
Well, so many of our compatriots, other strategists, economists, love to make the big market call. And they've been wrong just trying to call the market. And I think that they've really missed that the stock market is a market of stocks. And that's what's maintained our bullish stance, quite frankly, and consistently. And some people have called us stubborn since 2009 when we came out with this call that U.S. stocks have entered a 25-year secular bull market. Now, it's tough to be bullish that long, especially given all the negativity and all the doubts. And in your first hour today, you had Mr. Cramer talking about sentiment being still negative, and it's true. And even the great Tom Lee earlier this hour was talking about all the cash on the sidelines and investors really doubting this, Carl. And it continues. It just baffles me. But for our sense is this, is that the U.S. market, in terms of an equity asset, remains the best asset in the world, number one. Number two, you get what you pay for. Too many people are focused on valuation. Valuation is the world's worst metric in terms of forward performance. Number three, in terms of what we're going to be seeing over the next 3 to 5 years with respect to U.S. growth, it is going to be consistent. We may have other areas of the world that are seeing quote-unquote snapback growth, but in terms of earnings growth consistency, we continue to believe it's going to be the United States.
So that leads you to what, your $275 number on EPS?
It does. And our base case is 275, Carl. But we think that as we poll our clients and we look at other Wall Street research in terms of the financial sector especially, we think earnings in the U.S. financial sector are massively understated, with a big catch-up trade coming on the earnings front, with the broader theme of scale asset managers and broker-dealers, scale meaning the big banks, but also their very small banks we think can do very, very well. And just polling our clients that we speak with, we continue to believe that the majority of clients on the institutional side are at best neutral, meaning market weight financials, and there's more to come there.
So you sort of poo-pooed the valuation argument as a reason to be cautious. So what do you think is then a reasonable valuation, and when do you start to pay attention to it?
That's a trap question, Sarah. Thanks for trying, but I'm not going to give you a number, because I think anybody that says 22 times is the number, that's simplistic math. The market is not as easy as coming up with a valuation metric and an earnings target. That doesn't equate to how you model markets. We model markets from a macro PE compression, longer-term PE trends, and a dividend discount model. When you take a look at the dividend discount model, we can squarely get to 6,700, especially where rates are going to go. With respect to where you look for value overall, we can talk about that. We've been bullish in print in the published marketplace for well over a year on small cap stocks. Other people talk about small cap stocks, and we've been in print on it. Why? If you take a look at all valuation metrics, not just PE, if you look at PE, price to sales, price to book, price to free cash flow, operating metrics like return on assets or return on equity, Sarah, these small cap companies look amazing, and we're starting to see more and more broadening out with respect to performance there. From a fundamental perspective, we really think small cap stocks and mid cap stocks are going to do amazing over the next 3 to 5 years.
Okay, so I did go ahead and sprinkle in there another clip from BMO. I think that provided a lot of great insight, maybe to some of you guys that are getting a little bit nervous here. If you don't, obviously you shouldn't just outright agree with everything that I say, but if you just really don't agree with anything I say, then maybe hearing it from someone else, maybe that's a little more quote unquote qualified, can open some perspectives out there. And that's what's important right now. If you are a bear, I think you want to be open-minded to the bullish thesis. If you're a bull, I think you want to be open-minded to the bearish thesis. Even though I'm very bullish on Tesla, I'm very bullish on small caps and mid caps and cyclicals. I've said this for months now, in these videos, I acknowledge that we will probably get a correction in Q1 of 2025 based on expectations being too high, based on Trump tariff policies that may not be looked at as favorable, even though I think it's going to be a little bit of fishing, right? Trump's kind of going to throw his line out, see what happens. If there's too much negative reaction, too much implied economic weakness, you're not going to get that tariff, right? So I don't think the outcome is going to be nearly as bad as the markets might perceive the guaranteed outcome to be. Markets might freak out on a certain tariff one day, and then we realize, oh yeah, that's not going to happen. And then it's kind of no big deal again. I think that could start in Q1. I also think with potentially a normalization in the economic data, meaning we may not get as many revisions. The data might come in a little bit more accurate given the election is over. I'm not the first one to say that. You could see the economic data look like it's slowing down a bit. Now, that's good on one hand because it means the Fed's going to be cutting rates, but that's bad on the other hand because it means there's going to be more uncertainty about, the soft landing or not, right? Are we going to have a soft landing or we're not going to? And that tends to make Wall Street pretty nervous. So from that standpoint, I think you want to be open-minded. Again, I think there's going to be a correction in Q1, but I think it's a very buyable correction as long as we don't go into a recession. Now, recessions tend to sneak up on people, and I don't know if we're going to avoid a recession. I think the odds, though, have dramatically went up of a soft-ish landing. Are we going to run at 3% GDP for, the next year? Probably not. Are we going to be positive on GDP? I think the odds are good for that, especially what I'm seeing in, the real economy now. For a while there, it was looking bleak. Now it seems a little bit better. It seems like people are gaining a little bit more confidence now that Trump is the president, or will be the president on, January 21st. I think that can be pretty impactful to how people spend their money. You are seeing, confidence going up, things like that. So, just be open-minded. I want to know what you guys think about the markets and, the economy here. But there is areas that are not attractive at all, like big tech. And there's areas that could do very well, like, again, small caps, mid caps, and cyclicals. But it's kind of weird because 35% of the market is big tech. If big tech does not do well, that could put a lid on the index level performance of the S&P. But you could see a year where the Russell goes up maybe 30% next year and the S&P goes up like 10%. Okay, that is possible also. So I think you want to be a little bit careful how you're allocated in markets. Now, if you're watching this video and you're all in Tesla, I think you're going to do just fine. I think Tesla's going to outperform the Russell. I think Tesla's going to outperform the S&P. So I wouldn't worry too much there. But this is really for everyone else that is maybe more indexed or, not in small caps or other areas. I don't think this is the time you want to be excluding, the small cap trade in your overall investing thesis. Now, why I'm bullish on Tesla throughout the rest of this week, I'll briefly explain this. Option activity today, despite Tesla falling over 4%, you had 284 different trades from hedge funds and institutions. This is big money. This is not retail investors. It was $221 million with a positive order value of 83%. That's very strong. You also seen about 2.42 million shares that were covered on today. Typically, if hedge funds, institutions, short sellers in general are covering on a 4% down day, that tends to be a good sign, because if you're bearish on a stock and again the stock falls, you don't tend to want to cover your bet. Now, if you were bearish and you've gotten bullish and you have not covered your bet, your negative bet, and the stock falls 4%, like you're getting a 4% better deal to cover on your short position that you're losing money on. Right. So I think that's kind of what is going on here. You also see sentiment barometers like over on StockTwits going up day over day. Yesterday you were neutral at 48. Today you're bullish at 57. And I do think with the seasonal kind of Thanksgiving optimism that we're likely walking into the rest of this week, there's a strong, argument to be had that Tesla could bounce back from some of the negative sentiment that we have today. After all, I don't think the whole California EV credit thing is gonna mean anything for Tesla, and I think any logical investor could see that. But again, it is low volume, and you do have not as many people in the office, and some people are just not as smart as you. So, you know, that's worth keeping in mind, that obviously nothing is a guarantee. So these are kind of my overall thoughts. I still think Tesla could potentially reach $400 by the end of this week. It is a very short trading week. Monday's already done. You have tomorrow, which is Tuesday. You have Wednesday, and then you have Friday. You have a half day Friday. That's it. So you really only have 2.5 days left of trading for Tesla to reach $400 per share. You know, am I going to hold my hat on this? Am I betting the farm on this outcome? No, but I do think it's possible, and it wouldn't surprise me if we are $400 by the end of this week. It would be about 18% higher from here. I think in a 2.5 day period, as long as those 2.5 days are good, Tesla could reach that. That's like 2 7% days back to back and a 4% day, or a 10% day and then a 4% day, right? I definitely think an upside move would make sense, and probably a pretty aggressive one following a 4% sell-off that shouldn't have happened in the first place. Hey, strong opinion. That's my opinion. If you come here for strong opinions, well, you're on the right channel. If you don't, well, then this is probably not the channel for you. So that's going to go ahead and do it for this video. Ladies and gentlemen, that is what you need to know and what you probably didn't need to know, including my opinions, because it's always helpful to know opinions, but you should always come to your own conclusions and formulate your own opinions based on a lot of other different people's opinions as well, not just one person. So not financial advice. Do what you guys want to do. Enjoy the rest of your day. Have a fantastic day. And I will see you in the next one.